Thanks for joining us here on Market Call. I'm Morella Fernandez. Paul Harris is on the show today. He is portfolio manager at Harris Douglas Asset Management. And today he's taking your questions on North American and global stocks. Here's how to reach us. 1-855-326-6266 if you want to call in with your question. You can also email your questions to marketcall@bnnbloomberg.ca. All right, Paul, we are seeing the markets rally it back to life a little bit today. Tech stocks are actually doing pretty well. What do you think is spurring the action today?
I have no idea. So I think that, you having these kind of bounces all the time, I'm not sure, it goes back to the fact that I think we're just going to have volatility up or down over the next little while. And I think that's to a great degree to do with the uncertainty from the U.S. administration, whether on tariffs and all these other things. And it's not like, as an investment manager, as a company, if somebody running a company, you always make decisions within a degree of uncertainty, right? But it's the level of uncertainty that you're seeing presently that is so difficult for a lot of people. And I think that that is going to lead to a very difficult environment down the road, because companies and people will never not be able to make the right decisions for the long term on capital expenditure, et cetera. So it'll be interesting to see what happens with earnings that come out from a lot of these big tech companies, because at the end of last year, they basically said they were going to be spending up to, I think Microsoft was spending $80 billion, Google was spending $75 billion in capital expenditure. So are they going to pull back on all these things because of uncertainty? Will be interesting to see in their numbers when they come out over the next little while. So I think there is a kind of feeling that because of this uncertainty, because you're causing kind of consumer sentiment to be negative, small businesses are also have very negative. You are going to go into definitely a slowdown, probably a recession, and I think that would lead us to the kind of argument from an investment point of view that you're going to see lower earnings growth on the S&P 500. And the earnings growth numbers are pretty high still. They probably will come down, and therefore the multiple in the U.S. will probably contract. Now, saying all that, of course, it's always to be terribly negative in this environment is not also a good thing. There are opportunities in companies. A lot of companies are down, and there's a great chance to pick up if you really have done your work and you have a long-term view. I think a great opportunity to pick up some great businesses at much lower valuations than you've seen in a long time. I think the risk in the marketplace is that this uncertainty continues, and I think you're seeing a little bit of that in the way the U.S. dollar is reacting and the way the bond market's reacting. Usually, when we have kind of very difficult situations around the world, the U.S. dollar rallies, and the bond market, rallies as well, meaning prices go up and yields go down, and that's really not happening. And so there's this perceived notion that the world is looking at the United States and saying it's just too unstable, and the U.S. dollars that I got from whatever I'm doing, I'm just going to either just put it into my own currency or diversify it into other currencies, and not buy the U.S. bond market as well. And these are very difficult things because, the U.S. depends upon people buying their debt, right? So I think it's a very difficult situation. And finally, I think Donald Trump's issue with Powell is very awkward. If you get rid of somebody like that and put in somebody that's a political person, it just leads to the failure of the Fed being independent. And I think that's even worse. And I think that's what happened yesterday, where you saw him calling him a loser and all these other things.
Yeah. The usual insults.
Yeah, unnecessary things, right? Which I think it doesn't help him in any way. It really hurts his. He wants Powell to be kind of on board there to get them through a more difficult time with tariffs and stuff like that, right?
But the decision has to be made free and clear of the politics of the
environment. So I think and there's always political pressure on the Fed no matter what, and I think they've tried to stay away from all that stuff. But you're name calling and all stuff seems unnecessary from the President of the United States.
Absolutely,
right?
but has for a long time. Okay, we're going to leave it there for a moment as we line up some of your phone calls. Paul Harris with us today, portfolio manager, Harris Douglas Asset Management. He's taking your questions on North American and global stocks. We're back in a moment. Welcome back to Market Call. We want to get to an email first. Betty has written in, and she says, between Royal Bank or National Bank, which would you recommend? We'll turn that over to Paul. Royal Bank, of course, is the top notch that people tend to recommend, but where would you land?
Well, I mean, I think the issue there's in some ways they're similar companies in some ways because they both have very large domestic presence. Although National Banks tends to be obviously smaller and more in Quebec, and with their purchase of Canadian Western Bank, they're kind of changing that. But generally, I think that they're both much more domestic-based banks as opposed to for a TD or a Bank of Montreal or something like that, or Scotia. So I think that's one of the things that's helped the Royal over the long term. I think where I think the Royal will benefit more than and if you looked at the Royal's numbers and National Bank's numbers in the last quarter, they were all very good, right? And they all beat numbers and in all their different divisions grew. They took a lot of them increased their credit provisions, but that was expected, I think, to a certain degree. But I think where Royal benefits a lot is because Royal has a very large capital markets business, and it's global. Although it's not as big as Goldman or any of these other people, they still have a very large capital markets business, and this volatility kind of helps capital markets a lot. Maybe you're not going to get the M&A that people are expecting, but you are probably going to get a lot of trading going on, and you've seen that already with trading numbers explode, trading on debt and equity and all kinds of other derivatives that are trying to hedge these situations. So this kind of volatility generally helps these kind of institutions on the trading side. So I think that'll help them more than National, because National tends to be much more of a domestic bank in that area as well. But I think they're both very good business because they're sort of protected. Finally, I would say the Royal, if you do, there's this expectation in the United States that there's going to be some deregulation on the financial services side. If you do get that, the Royal should benefit a lot more than National because they are much more of a global player. They're in the United States in a big way, not in a retail perspective, but in investment banking and all these other things. So they should benefit a lot more from that. Okay. But I think they're both being very domestic helps them in this environment.
Got it. Okay, let's go to the phone lines. We have Jim on the line. He's calling us from Elliott Lake in Ontario. Hi, Jim.
Good afternoon. Paul, I'd like to ask you about Taiwan Semiconductor. Well, as we've seen with all stocks, they've all been hit pretty hard here in the shorter term. Long-term numbers seem to be obviously very good here. Do you see this as an entry point, a good buying opportunity for Taiwan Semiconductor?
Yeah, so Taiwan Semiconductor is an incredible company, right? I mean, basically they are a fab, which is, and they're at the top level of fabrication of semiconductors. So most semiconductor companies like Nvidia actually design them, but send them to Taiwan Semiconductor to make them. And so I think the thing that's hurt Taiwan Semiconductors is that there's this kind of issue with tariffs going on and the technology issue with Taiwan Semiconductors because they're at a very high level. They make this, their fabs are highly technical. And so, yes, they're moving some to the United States, but they really are in Taiwan. And so the other issue is obviously this issue with China may want to take over Taiwan at some point in time, et cetera. So there's always these issues, but I think that what's hurt them the most is this tariff issue with their semiconductor companies that they provide for. And you saw that Nvidia took a big write-down because of that. So I think that that's what's really hurting these companies. This is a company that's way ahead of anybody else. I mean, Intel's not even close to them anymore from a production point of view. The Japanese companies, although are very good, but they're very good at specific things, and so they're not at the leading edge of manufacturing on semiconductors. So they have a big edge than everybody else, and I think it's a great time to buy these companies if you can wait it out a bit, because I think there'll be more volatility throughout this period. But I think that Taiwan Semiconductors shown to be a great business and a great company run incredibly well, and I think that it's worth buying in the long run.
Do they have exposure? Because they've now announced they're going to build in the U.S. right to satisfy Donald Trump. They're going to build some manufacturing in the U.S. But as you say, they're primarily out of Taiwan.
Right.
But they're out of the U.S. Authority, meaning the U.S. can't really say, hey, stop doing this. I guess they could and deny the protections.
Actually, the U.S. has a lot of power to stop doing that very much, like they did that with ASML, saying you can't send your equipment over to China, right? So they can do that. But I mean, it takes a long time to build a fabrication plant. They're huge, right? And they're very technically based. So it's not something that it's going to happen overnight. Although they're obviously they're starting to do that in Arizona. So I do think that there's a opportunity that it'll be calmed down a little bit, but the issues are still, quite dramatic with these tariffs, right?
Got it. Okay, they are down to 150.55 from the start of the year. They were up at 250. We'll go back to the phone lines. John's on the line. He's calling from London, Ontario. Hi, John.
Hi, Marilla. Hello, Paul. Bought Aritzia early in the pandemic, rode it up, rode it down as low as 18, picked up some more, rode it up to 60. Now it's about 42. Raymond James comes along with a pro forma margin analysis and says the total effect of the tariffs on their part is only about 2.5%. Is this a buy right now? Thanks very much, Paul.
Okay, so Aritzia down to 43.44 today.
Yeah, so I mean, I don't know the company, but I mean, I think the issue that these companies face is because where their manufacturings are, right? And I think that the problem with that calculation on the margin, it can be substantially lower given some of the issues they face, and it's hard to probably move manufacturing someplace else, right? So I think that the margin hit they're going to be taking, even though it's been calculated, the gentleman said 2.5%, I think, it could be more than that, given you're not sure about how all these things are going to play out. So there's a lot of uncertainty around that, and I think it's hard to calculate all those numbers presently. So I think that the stock will probably, probably can fall further from here, but it's probably an opportunity after that to buy it. But I do think that it's a much more difficult calculation to make when the guy changes his mind every day, right? So I think that's the hard part about that. It's not that, it's a great business, it's a great company when everything's working well and the supply chain's working well. But if the supply chain breaks down somewhere along the way and the costs go up and you may not be able to pass on those costs as aggressively as you think, it becomes the company that takes the hit on the margin requirements, and it could be more, right?
Okay, so you're not sure that the cost exposure here is fully shaken out?
I don't think so. I mean, I think it's much more difficult I think in this environment, it's much more difficult to come up with that number. And I'm not sure is it 2.5%, is it 3.5%, is it 5%? Who knows, right? And who knows how this company has to deal with that. So.
Got it. All right, we are going to take a quick break. Paul Harris sticking around to take more of your questions in a moment. Stay tuned. Welcome back to Market Call. Let's go right to the phone lines. Kevin's been holding on the line from Kingston, Ontario. Hi, Kevin.
Hi, thanks for taking my call. We're pretty in volatile markets, and I'd like to know where his bottom round is for the S&P 500, because that'll determine where most stocks will be bottoming out as well. Thank you.
Right. So that's thank you very much for a very tough question, Kevin. No, I'm not sure where that's going to be, but let me just give you some context around what I think's happening, right? So the S&P 500, the earnings numbers on the S&P 500 are high. They're generally very high anyways, right? But they haven't come down as probably given issues with these tariffs and the way the world is slowing down enough. So that I think is the determinant about what's going to happen with the S&P 500. I think their numbers are at somewhere around 262 or 260. If they come down to, they may even drop to 250 or something like that, and you may lose a lot of earnings growth this year. So that's one thing. And I think people, a lot of strategists and people who may be bearish about the stock market have always talked about mean revision and coming back to the mean of the S&P 500. And I think that's the risk, right? We go back to a period of time where the S&P 500, the average is about 16 or 17 times. We go back to that level, and that would probably be the level you'd certainly want to buy the stocks at it. But I think that's the risk in the stock market today, that given all these things, that earnings are too high, that we could have earnings come back down again to a more, because of people have to kind of reassess especially after we get this next quarter's company numbers. Mm-hmm. This quarter should be good for most companies, right? Because they didn't have any of these issues. Next quarter, maybe
might
more
be a different story.
Right? So I think that's the thing that you have to look at, and so that may determine where we go down on an S&P 500 and trading at a much lower multiple. And if the other thing that's happened with the S&P 500 is that you've had a massive multiple expansion over the years. It's not that earnings growth went up so much; it was the multiple that expanded, right? So the issue is that you may get a shrinking of that multiple. Hopefully, it doesn't get to 16, but I mean that's the kind of downside I would look at, where it gets to the average, right? And I think that'll be certainly a great buying opportunity.
Got it. Okay, let's go back to the phone lines. Amato's on the line, calling from Montreal today. Hi, Amato.
Good afternoon. Thank you for taking my call. My question for Paul is on Meta. Is this a buy at the prices that it's trading at now? Thank you.
Okay, so let's have a look at Meta. We'll pull up that graph right now.
Yeah, so Meta's fallen a lot over the last little while. I mean, it had a really good run into the inauguration and all those other things. There's two things happening at Meta. One is it's in this massive trial with the FTC, which is looking at their purchases of Instagram and WhatsApp. And although the FTC approved it, they're now going back and saying, well,
they own too much social media. Is that the
yeah?
argument?
I mean, they basically have a monopoly,
Yes.
effectively, right? And in that area, and so their argument obviously is not, because there's TikTok and all these other things, YouTube, et cetera. So, but the argument they're trying to say is that you are a monopoly, and so we want to break you up, and by breaking you up, we will break up Instagram and WhatsApp and take those away from you. It's a hard thing to do, given kind of the laws of the United States, and also they approved it. So going back and saying something is a much more difficult argument to make. I think that's what's kind of, and there's some very, like everything, they get all your emails, and Mark Zuckerberg saying, oh, well,
all that information.
I'm really worried about this and that, so that we should do this and that. So like similar to what happened with Microsoft, right, where Bill Gates was saying, oh, we have to, do this to them, these people. So I think that's kind of the issue with all this stuff, and you're seeing all this kind of dirty laundry come out. So that's hurting the stock. But I think in the long run, Meta's if they don't break it up, Meta's in a very good position, because it's the issue. They're really not in China. That's one thing. They're not really affected by these tariffs as much. They actually can use, when people talk about AI, they're actually using AI a lot more already in advertising and stuff like that. So you've seen, that issue with AI and how it gets a monetary return, or monetizing AI, is happening a lot more at Meta on the advertising side. So I think Meta can benefit from all that stuff. I just think there'll be just some volatility, and you may be able to buy it a little cheaper here, but I think buying it here is not going to hurt you at all if you have a kind of a long-term view on the stock.
Got it. Okay, let's go back to the phone. To an email. Sorry, this is from Steve. Steve says, Paul, what do you think about Enbridge as an income investment?
We've owned Enbridge for a long time. We like it. It's a great income investment, of course. It's got a great dividend yield. I think Enbridge talked about, how they're going to continue to, I think they're going to return money to shareholders, a fair bit of money, about $40 billion over the next 3 to 5 years. They're also, going to continue to expand the main line and continue to expand CapEx. I think one of the issues with a lot of these kind of infrastructure companies in this country, they've actually become much more U.S. based in some ways, because a lot of their last acquisitions are all being U.S. right? I mean, I think there's this idea now in Canada that we're going to think about our pipeline businesses, our infrastructure businesses very differently, because what's happened in the United States. But when they've had real trouble doing a lot of that stuff in this country, and that's why they've gone and made purchases in the United States, right? But I think Enbridge is a great story. I mean, they continue to execute very well. They are, they actually have a plan going forward for the next several years to return money to shareholders, but also to, they're on their CapEx side, and they've been executing very well. So I think it's a great dividend story.
Got it. Okay, let's leave it there for this block. We're going to take a quick break. When we come back, we'll have a look at Paul's past picks. We're back in a moment. Welcome back. Time now to take a look at Paul's past picks from April 10th of 2024, so a year ago. At that time, he chose Stryker out of the New York Stock Exchange. It was $347.33 at the time, and now at $343.12, so down 1%, up just under 1%. And I'm just wondering, they make surgical and medical products. You'd think that there would be a sustained need. Why are we seeing a bit of a drop there?
Yeah, so I mean, I think like a lot of this stuff is just because the market is, falling, right? So I mean, in the market, it's more difficult. I mean, it's not a cheap stock, but it's exactly right. They make medical devices. They make hip replacements, knee replacements, spine, hand, and ankle replacements, and it's a great company. It's very. They're about 73% in the U.S., the rest of it in the rest of the world. So there's a lot of growth internationally for this company. And there's a bit of an annuity and a demographic play, because a lot of people, as they get older, require these things. And then on the annuity side, most surgeons learn to use these things. They're quite complicated. They don't switch around each time they do a different thing. So there's a bit of annuity on that side, but we see it as a very strong demographic play, good growth. They tend to do small acquisitions or tuck-on acquisitions, over periods of time because they don't kind of, when they look at people doing certain kinds of technology that they want, they'll go and buy them. So I think it's a great business. I think it's just with all these things, like the stock market has come down, not necessarily because this is not a good company. It's come down because the environment's very difficult.
So generally drag down everything else.
Yes, that's right.
Let's go to your other past pick from April of last year, which is EssilorLuxottica. At the time, 108.21 American, and now at 143.13. So a 32% upside return, 34% total return, and they do sort of higher end, I guess, eye products and eye care?
Well, so what they do is they do two things. Essilor was a French company that made lenses, right, and optical lenses and stuff like that. And Luxottica was a frame company. And they both had, like Luxottica had frames, of course. Essilor had frames as well. But they would come together. So, Ray-Bans, Oakley are owned by this company. So Essilor was the kind of the technical side, and Luxottica was the kind of the more retail side of the business. So they put these two companies together, a French and an Italian company. It didn't sound like it was ever going to work out, but it has. So one of the things that's happened has been very good. They've been able to cut costs. They made a big acquisition called Grand Vision, which gave them a lot more capacity. They're vertically integrated, so they do every aspect of a eyeglass. Eyeglasses have become, one, a fashion statement, so people tend to buy them for that. But also, eyeglass use has gone up over long periods of time because of us using a lot of technology, which requires us to look at kind of things or things. So, and especially with young children, actually. So there's a really kind of young children don't use contacts, they tend to use glasses. So there's been a really good growth in the business. And the other thing that's happened is, and this is why Meta is in a kind of a joint venture with them in a funny kind of way with Ray-Bans, trying to make eyeglasses.
Bring the technology to a Ray-Ban. Okay.
Yeah, right. And so there was some talk that Meta may even actually take a position in Essilor, but I think that's kind of key because it's got great demographic numbers, like a great business. There's a few on the eye kind of glass side. There's very few it's almost a monopoly. Well, not a monopoly, but a oligopoly. So they have a really great business, and the technology is fantastic. So I think, if you used to get bifocals, you have to have a line in them between. Mm-hmm. Now that you don't have that, right? That was them. So there's a lot of, that's what's really helped the company out over the last little while. It's a great company, great European business. And then if you go and buy Dior or some of these high-end frames, it's all made by them.
Got it.
Right, so they do all kinds of different things. It's just not that they do Oakley and the Ray-Bans and stuff like that. They own Sunglass Hut. So.
Across the market. Okay, let's get to your last pick from last year, which is Novo Nordisk, which is known, of course, for their injections for diabetes, which has worked as a weight loss, and it has dropped over the last little while. So it was 124.93 when you recommended it last year. Now it's down to half that, 59.93. So 52% drop return, 51 on total return. And is that because of the competition now in this market?
No, I don't. No, it's not because of that. So Novo, I think these companies were highly rated, and so that kind of hurt them as a general rule. And there was a lot of expectations in the company and their second-level drugs. Novo came out with a second-level drug that they said they were going to have 25% weight loss. They had 22.7% weight loss, and the stock fell 21%. Right.
Wow.
So the market is things. So there are really two players in this market. Novo is the largest. Is actually larger than Eli Lilly, and Eli Lilly is grabbing a lot more market share. So that's one of the reasons why you're seeing this. But there are only really two players. This and Eli Lilly in that area. Other companies have come along, but they haven't got the drug to the phase 3 level. In fact, you saw Pfizer kind of quit the market because their drug was not working that well. The other problem is that these guys have built a lot of manufacturing along with this, and when you have a drug like this, you have to manufacture it. It's not an easy thing to do. So that's one thing. And this drug is shown to be very useful with heart disease and fatty liver and sleep apnea. So all those things are there. I think the other issue with all this stuff is there's a feeling in the United States that there's going to be tariffs on pharmaceuticals. Mm-hmm. And so they're going to have to face this because these drugs are very expensive. They're not cheap, but they work incredibly well. And everybody's trying to. So I think the last thing I would say is that if you're on Ozempic, right, you're not switching to the Eli Lilly version because you're just not going to do that because you're used to either the side effects or whatever. So you don't know what they're going to be, right? So it's not like people are switching here and there because it's thing. It's just the reality is that they were overvalued. They came down. It's been a tough market for these companies in the last little while. But I do believe if you're buying the company here, you'll do well with it over a period of time.
Got it. All right, we're going to take a quick break. Paul Harris is sticking around to take more of your questions when we come back. Welcome back to Market Call. We want to get to an email from Marcelo. He says, hello, Paul. Could I please have your thoughts on Power Corp?
Great. So Power Corp is a company we've owned for a long time in our dividend portfolio. I mean, the dividend yield is about 5%. So I think the way you have to think about Power is it's a holding company for a bunch of public companies. One is Great-West Life. The other one is IGM Financial, which is Investors Group, and then Brussels Lember. So those are the companies that are kind of public that they own. And I think the NAV is somewhere around $64, and so it's trading at a discount to its NAV. And it usually does trade at a discount to its NAV. I think they did a few things that helped it narrow that discount several years ago by changing the structure a little bit, which helped. But I think it's always going to kind of trade at a discount to its NAV. I like it because they continue to increase their dividend. I think the dividend yield is around 5%. I think they will continue to increase their dividend over each quarter. And you've got, so the issue becomes, do you want to hold the holding company or do you want to hold the underlying assets? Yes. I've chosen to hold the holding company, but you can obviously own the underlying assets if you believe in, but it's, you have to go and actually look at.
How do you decide? I mean, what is better about the holding company versus the asset and vice versa?
So I always felt that they would, all their money is in the holding company, so I would figure that they would want to narrow the discount, right? So that's what I've always felt about it. But to me, when I looked at both those things, I had already owned an asset management business through other things, so I didn't want to own that. And I owned other life insurance companies, so holding this would, I felt would be a better methodology, that's all.
Are they less exposed to the volatility, the holding company?
Not really, because the way they come up with that net asset value is determined by the underlying assets, right? So they look at the price of things. So, like, for example, IGM will obviously have, because of the volatility in the marketplace, may have assets go down by nature, and so they were going to get less fees. So that may be a more difficult thing. So I think that's they're not. I mean, the life insurance business is probably less volatile, but the investment management business is probably a lot more volatile in an environment like this, right?
Got it. Okay, let's go back to the phones then. We have Bill on the line from Bowmanville in Ontario. Hi, Bill.
Hi. Can I have your guest opinion on Google, and would he buy it today? Thank you.
Think you. We'll bring up Alphabet, which is the parent company, and Google is also involved in a case with the Department of Justice in the U.S.
Right, and actually the same law, in the same courtroom, so like the same courthouse, right? So Google is a company we've owned for a long time. I think that Google continues to be one of the cheapest technology companies around. It trades well below the market multiple presently. Google seems to be undervalued all the time. When you look at their search business, it grew in their last quarter. YouTube grew, and their cloud business is also growing. So they have a bunch of businesses that are growing really well. The issue, like I brought up earlier on, is that we'll find out a lot more in the next quarter or the coming quarter exactly where CapEx is going to go, because a lot of the money they're spending, about $75 billion, is on the AI side. And so whether that's going to change or not over the next little while for a lot of these companies, whether it's Microsoft or these guys, is going to be very important, right? So I think that to me it's a cheap stock. I think you're getting a lot of great businesses for very cheap. Now the issue is this FTC argument.
You're worried about it.
Right.
They're accused of being a monopoly as well.
Yeah, they're accused of being a monopoly. They want to break up certain parts of it, not in the same way as they may want them to sell off sort of some of their businesses, either
Chrome
search
browser or something like
Chrome
that.
or even the Chrome browser business or the underlying business for all the cell phones, right? So the problem with a lot of this stuff is that they can say, we want you to do this, then they're going to appeal it. And
it'll take 10 years.
Yeah, yes. It goes on forever, right? So the problem is the company being run properly presently? It is. Yes, it takes their focus off a little bit of the stuff like it did at Microsoft for a while. And the problem with what happened with Microsoft, and I hope it doesn't happen with Google, is that they started to take less risk in their businesses. They didn't make good decisions, and so it caused them to miss sort of the cell phone business and all these other things, right? So that's the difficult part about being under the microscope like this, right? But you know, they made a big acquisition recently on the cybersecurity side, which they probably wouldn't have done years ago with the Biden administration. So they're hoping that, you know, this will go through. So I think there are things that they're doing that kind of to grow their business and to make it you know, bigger. But I think that, you know, they're under this microscope and they've got to be careful.
Okay, so would you dip in at this point, though?
Yeah, I would certainly buy it because I mean, I think that over the, you know, I mean, I know earnings are coming out, so it's going to be, it may be slightly volatile around that number, but I think it's somewhere around in the next little while. You're not paying a lot for this company nowadays, right?
Got it. All right, let's go to another email from Richard. He says, would you recommend I continue to hold Amazon? Okay, Amazon also one of those Magnificent Seven that has dropped. What's your forward look on Amazon?
So if you look at the last quarter on Amazon, right, and you say, and I mean, I'm not sure what the next quarter is going to be like. It should be okay because it's, you know, it's a different kind of period. But if you look at their quarter, they grew their retail business, they grew their cloud business, they grew their advertising business, all by double digits. And on top of that, which is, you know, now they're 60%. They've increased same-day delivery by 60% in 140 metro areas. Like, it's pretty incredible on the logistics side what Amazon has done, right? And so I think that, and I think in the next little while you'll get 24-hour deliveries at Amazon, right? So
what happened to drone delivery? I'm still waiting for that.
Well, but you know, I mean, you could order something and they drop it off at 2 o'clock in the morning at your front door. So I think that you know, Amazon is a great business. I think if we go into a recession now, the one issue is that a lot of the stuff comes from China and all these other places,
yes.
so there's going to be some tariff issues with that and costs going up, but I think they can pass that on to a lot of their customers. That's one thing. Number two, in a very bad environment, people like Walmart and Amazon actually will do well because people will go to them more often because the prices will still be cheaper, right, than going to a store and buying it. So they're going to get a larger share of the wallet, I think, in a weaker environment, right? So, but like I said, a lot of their numbers come out over the next little while, so it'll be interesting to see. Even Amazon was going to spend a lot more money on AI. So I want to see those kind of numbers coming out. And I guess the trouble for a lot of people analyzing these numbers today, it's what they're saying about the next quarter that's going to be important. It's not about this quarter because this quarter should be okay, right? It's the next quarter that they're going to be worrying about and talking about. And I think that's where you're going to see maybe some volatility around a lot of these stock prices.
Mid to end of the year. Okay. Paul Harris is sticking around, of course, take more of your questions, so you can give us a call or send an email in. We're back in a moment. Welcome back, and thanks for joining us here on Market Call. We want to go right to your phone calls. Sal is on the line from Toronto. Hi, Sal.
Well, hi. Yes, my question is on Celestica. I was wondering if now would be a good time. It seems to have stabilized a bit in the last month or so, and just thinking it is a hyper volatile stock. So thinking if there's a further downside or if this is a good time to add. Thanks so much.
Okay, Celestica.
Right. Yeah, so I mean, I think obviously Celestica is, you know, benefited a lot from, I think, what was perceived to be a kind of this issue with AI and stuff like that. And I think that's what pushed up the stock from last September on, and where it had this massive run up. And you've seen a pullback on all the stuff. And I think that, you know, I think it's a good company. I think that if you can buy it at a reasonable the price here, you'll be fine. I think, like you said, there is going to be some volatility around a lot of these things. So I would really wait to see a lot of the some of the expenditures that you're seeing, if they're coming off a lot from a lot of these big companies, and then I would look to buy it as opposed to necessarily doing it here, because I think it's there's more. I'm not sure what's going to happen with this stuff, so I think that's if you have some time, I think it'll be better to wait a little bit to buy it here.
See if it goes down a little bit more.
Yeah, because I think that it benefited from a lot of things that may change over the next little while. I'm not trying to say that AI is going to go away. A lot of those things aren't going to go away. It's just that their ability to, a lot of these companies, because of the environment they're in, may take the opportunity to say, well, I want to pull back a little bit, and that alone will hurt a lot of. It may hurt their own stocks, but it also may hurt the periphery stocks down the road from them, right?
Got it. Okay, let's go to an email from Chris. He says, I would appreciate your opinion on Kraft Heinz. What's going on with Kraft Heinz?
So Kraft Heinz obviously, you know, is a food company, makes a lot of, you know, all kinds of different foods that they sell through grocery stores, et cetera. People will probably know Kraft Dinner as the staple thing. And if we go into a recession, it probably will do well.
Exactly,
right?
yes.
But, Kraft Heinz is not an expensive company. Well, it trades about 11 times forward earnings. It's got a nice dividend yield. I think that it's not like you've seen what you've seen in Canada when you've seen all these grocery stores go up and stuff like that, right? And they've done well because people think, but Kraft Heinz has had a more difficult thing. It's not been a very, the problem with a lot of these food companies, these kind of companies, as far as I'm concerned, is that they have very low returns on capital, and they haven't seen, although they're trading cheap, they tend to trade cheaply all the time, as far as I'm concerned, right? So I'm not a big fan of these kind of businesses. I think you're better off owning a grocery store than owning some of the things. And then the other thing I think with a lot of these companies is that they tend to have brands that, because they've been, Kraft's has been around since the 1800s, so they have these brands that they are not getting a great return on, and they just don't want to sell them off, right? So I think that's what these companies, and you've noticed with some of the ones that have done well, is that they've looked at these brands and said, I don't really get a great return on this particular brand. I'm either going to stop making it or sell it. So they need to kind of look at their brand and
more critically.
Right, more critically. And the other thing that's happening with a lot of these kind of name brands is that it's been easier for smaller companies to come along with better products, or more environmentally product, whatever the case may be, more nutritional products.
Yeah, I was going to say.
And they tend to get more. They get a lot of shelf space. Where years ago you couldn't get shelf space at Loblaws and try to push out Kraft, right?
Yeah.
It would be much harder.
For the vegetarian version of Kraft, now you're going to get some more room for that, right?
Yeah, so it's much easier to do that in the world we're living in today than in the previous world, where it was very hard to, push out those kind of companies like Coke and all these other things with brands, right? So I think that's the difficult thing that they're fighting. Kind of, and some of their stuff obviously is not as nutritional as you would think.
Sure.
Right? So I think they're fighting a lot of different battles, right?
Okay. Let's do one more email then. This one is from Rick. He says, I'm now retired and I own TELUS shares as part of my company pension. Their performance has been less than optimal for some time and shows no apparent signs of positive change. Would your recommendation be to hold or to sell, or to move to another dividend stock? Telecommunications companies, of course, having a hard time.
Yeah.
And TELUS is trying something new, right? They want to sell, I guess, part of their carrier system?
They want to sell their towers.
The tower.
Right. And so that kind of gave the stock a bit of a bounce, right? We own BCE, we sold it. I think part of the problem what we had with even BCE is that we felt that they're going to have to cut their dividend at some point in time. They're paying way too high a dividend. Similarly with TELUS, I think that's the case as well, that there's a large CapEx business. I think the other problem in Canada specifically is that the CRTCs are just a difficult environment to be in with them, right? Because they're constantly wanting to have 4 or 5 players and all these other things when we're a small country. So there's a lot of issues with their CapEx, the spending amount of CapEx that they have to do. And, all the times we bring in these other players, they go bankrupt and somebody else buys them. So I think the issue for me is that this is it's a tough business. We own TELUS, we sold BCE. We own TELUS because I felt it's a slightly better run company, and they don't have other parts of they have some really good businesses that they've actually nurtured over years and brought public and things like that. So they've done a good job with that. And they've got great management, but I think the environment is just very tough. And I get worried that even with TELUS may be forced at some point in time, if they don't, if they can sell off all these things and pay down debt, they'd be better off because they may have to force to be able to cut their dividend, right?
Okay.
So.
BCE, of course, the parent company of Bell Media, which
Right.
owns BNN Bloomberg, as well as CTV News. All right, that's all the time we have for your phone calls today. But stay with us. Paul will share his top picks. That's coming up in a moment. Welcome back. Paul Harris is with us. He's sharing his top picks right now. The first one is MSCI out of New York, and this is a provider of support tools of some sort, data analytics, that kind of thing?
Yeah, so MSCI provides kind of solutions and data analytics for the investment management industry and, and alternative asset managers. First of all, there's the MSCI indexes that people use to benchmark against. That's one of their big businesses. They do, performance measurement. They do risk management and all these things around investment management for investment management firms and alternative asset players. So one of the things they came out with their numbers today, I think the stock might have been down 1% or something, or a little less than 1%. They had some very good numbers, good growth, 10%, almost 10% growth. Their gross margins were down slightly. I think that's why the stock is down a little bit, but they have a 95% retention rate for their customers. So the one thing about this business, which is really great, is there's only really 3 players. There's MSCI, S&P, and the FTSE guys. So those are the only people that do really kind of index data and all that stuff. So if you're a investment manager, you actually have to have benchmark against an index, right? And people go, well, we can create our own index. Well, no, because if you're an institutional firm hiring them, you're never going to say, well, you can make up your own index. It would be terrible, right? You want an independent index player. So one is that they have this great business with their very high retention rates. The risks of the company, obviously, if there's a merger, then you don't need, together. So I like this business because I think it's an oligopoly. I think there's a lot of good growth in it over long periods of time.
Is there growth? That's what I was going to ask you.
Well, because not maybe in the traditional kind of business as we would see like an asset management company, but there's huge growth in the alternative asset class side. So they bought a real estate business on the indexing side. They can, there's all kinds of other more alternative asset classes. So there's good growth there. So I see that. And then the other thing is that it's not just the index side that's important, it's the analytics side that becomes very, very important to a lot of things. If you think about what's happened in the last little while with the massive amount of volatility we've seen, you understand the index and the risk management of your portfolio becomes very, very important, right? So you can do all that risk management side with these kind of things. So that's what I think where the growth is. It's not sort of, the index is, but that doesn't really, that'll grow slowly, but it's these other parts of the business where they give you a lot of analytics that are important.
Got it. Okay, let's get to your next top pick, which is Bank of America in New York, of course, one of the big banks in the U.S. Why do you like Bank of America over some of the others?
I've owned Bank of America for a long time. I've talked about it on this show for a long time as well. Well, I think that first of all, the stock has fallen a fair bit over the last little while. I think that was sort of unexpected given their kind of numbers that we saw in the last last week, really, that you saw good numbers from them as well. They've got great capital. So the American banks have got lots of capital. They've got they've got a lot of room to increase dividends and buy back shares. I mean, this environment is very tough for them simply because people are feeling they're going into a recession, and maybe that's why the stock's falling off. It's trading at 1 times book. It's trading at 10 times earnings. It's got a 2.8% dividend yield. So there's a lot of positive things about it. They've got some of the best businesses in the world, whether it's asset management, financial services. They have capital markets. They have a great retail business. And credit card business. So they've got a lot of businesses and a lot of more fee income. So I think that they're not. And I think there's a lot of room on the capital market side, like we talked about Royal, where this is one of the top 4 players in capital markets globally. And so they have lots of room to do well with all this volatility, right? I think one of the aspects of capital markets which people thought we were going to see in the last little while was large increases in M&A, and you haven't seen that as much. But I think that may happen down the road. And the other, so I think you've seen, you're going to see good rates of return on those businesses. So I think I like it here. You're not paying a lot for it, especially at 1 times book value. So I think that there's a great opportunity for the stock to go higher from here.
Got it. Your last pick, I think, is interesting because it's Nvidia,
right,
which has, of course, dropped a great deal and has been sinking even earlier this week. And did have that problem when the president of the United States says you can no longer ship certain chips to China, and that's a $5.5 billion write-down for them.
Yeah, so basically they took the write-down, and so the stock has fallen, and I think that right now it's trading at about 21 times earnings. I hate to say monopoly, but these guys really have a monopoly in GPUs. So there's nobody. AMD is not even close to them. Broadcom may be getting closer to them, but it's certainly not there yet. So, and they have a bunch of new products coming out with Blackwell. So I think there's AI is not going away. Yes, people may pull back on a lot of this stuff because they think it's a great opportunity to say, well, we're not going to spend as much and all these other things because of the environment. But I think as a general rule, people will continue to spend, and Nvidia benefits from all that stuff. And you're not paying a lot for the company presently, right? You're not. I mean, this was a company that is really growing earnings quite rapidly. They have a great balance sheet. They have no debt, and so you're actually being able to get a very good business, which is a leader, for probably, a very good multiple.
How much, we talked about the write-down for China, how much will that hurt them going forward? How much of their business really is done in China?
Yeah, so it's very hard to kind of tell because China's, some things get to China in a very different way, right? But I think that the real growth is with these big players like Microsoft and all that stuff in the United States and in Europe. And so, China is really, I think China is in a different world where they've decided that, they don't want to rely on a lot of these things. So they're kind of constantly kind of improving and being able to do a lot of these things themselves. So, but China does rely on some of their lower end stuff, and I think that's where they get hurt. But I think that going forward, it's just nobody's done as what they've done, right? And so, and I think it's very clear that they have such a huge advantage. Even if you can buy the stock around these levels, and if you see it get into the 90s, I think you won't regret that in a couple of years from now.
Okay, and right now it's at 99 from what we just saw with the current change. Okay, we do have to leave it there. Paul Harris, thanks for coming in. We'll see you again soon.
My pleasure.
And that is it for us here on Market Call. Thank you for joining us. We'll see you again tomorrow. A quick look at the markets as we head to a break.